Download this code from codegive.com, link in the description below. OK, let's delve into the world of margin accounts, why brokers often encourage their use, and the potential benefits and risks involved. This will be a detailed guide covering the mechanics, advantages, disadvantages, real-world examples, and some code snippets, though limited, as real trading requires connecting to broker APIs. Disclaimer **** trading on margin involves a high degree of risk and can result in losses exceeding your initial investment. This tutorial is for educational purposes only and does not constitute financial advice. Always conduct thorough research and consult with a qualified financial advisor before making any investment decisions. What is a margin account? A margin account is a brokerage account that allows you to borrow money from your broker to purchase securities, stocks, ETFs, options, etc. Think of it like a loan specifically designed for investing. Instead of using only your own funds, you leverage borrowed capital to potentially amplify your returns, and, unfortunately, your losses. Key concepts Margin the amount of equity you contribute yourself. If you buy $10,000 worth of stock and your margin is 50%, you provide $5,000, and the broker lends you the other $5,000. Margin loan the amount of money you borrow from the broker. Margin interest the interest you pay on the margin loan. This rate is usually based on a benchmark rate, example the federal funds rate or LIBOR/SOFR, plus a spread that the broker charges. It's crucial to understand that this interest is a cost of doing business and can eat into your profits. Initial margin the minimum percentage of the purchase price you must contribute yourself when opening a margin position. This is set by regulatory bodies like the Financial Industry Regulatory Authority, FINRA, in the U.S. FINRA typically requires a minimum initial margin of 50% for stocks. Maintenance margin the minimum percentage of equity you must maintain in your margin account relative to the total value of your securities. If your equity falls below this level, you'll receive a margin call. FINRA usually requires a maintenance margin of 25%. Margin call a demand from your broker to deposit additional funds or securities into your margin account to bring your equity back above the maintenance margin requirement. If you don't meet the margin call, the broker can sell your securities to cover the shortfall, often without your consent. Leverage the ratio of the total value of your securities to your own equity in the account. A margin account amplifies your leverage. For example, if you have $5,000 equity and $10,000 worth of stocks, your leverage is 2:1. Buying power the total value of securities you can purchase with your margin account. This is often expressed as a multiple of your account equity. Why brokers encourage margin account usage? Brokers have several incentives to encourage clients to use margin accounts. 1. Interest income brokers earn revenue from the interest charged on margin loans. This is a significant profit center for them. The more clients borrow, the more interest the broker earns. 2. Increased trading volume margin accounts enable clients to trade with larger positions, leading to increased trading volume. Higher volume generates more commission fees for the broker, although commission-free brokers still benefit from payment for order flow, which is also higher with increased volume. 3. Account growth brokers want to attract and retain clients with larger account balances. Margin accounts can lead to faster account growth, or faster account depletion, which, from the broker's perspective, is generally positive, as long as the client doesn't default on the loan. 4. Competitiveness brokers compete with each other for clients. Offering margin accounts is a standard feature that clients often expect. 5. Liquidity for the broker. The underlying shares purchased on margin are technically held in street name by the broker. This provides the broker with liquidity, as they can lend these shares to short sellers, generating additional income. Advantages of using a margin account. Increased purchasing power. You can control a larger portfolio with less of your own capital. Potential for higher returns. If your investments perform well, the leverage can magnify your profits. Flexibility. You can take advantage of short-term trading opportunities without tying up all your cash. Hedging strategies. Margin accounts can be used to implement sophisticated hedging strategies, such as short selling and options trading. These strategies come with their own set of risks. Avoiding liquidation. If you need cash but don't want to sell your investments, you can borrow against your portfolio using margin. Disadvantages of using a margin account. Magnified losses. Leverage works both ways. If your investments perform poorly, your losses are also magnified. You can lose more than your initial investment. Margin calls. If your equity falls below the maintenance margin, you'll be forced to deposit more funds or have your securities sold at a loss. Interest charges. You pay interest on the margin loan, which reduces your overall profits. Increased risk of ruin. Poorly managed margin accounts can lead to significant financial losses and even bankruptcy. Complexity. Margin trading requires a solid understanding of market mechanics, risk management, and the terms of your margin agreement. Emotional toll. The pressure of managing leveraged positions can be stressful and lead to poor decision making. Broker control. The broker has significant control over your account. They can change margin requirements, liquidate positions, and even close your account if they deem it necessary. Real-world examples. Example 1, the upside, simplified. You have $10,000 and want to buy shares of Company A, currently trading at $100 per share. You can buy 100 shares. With a 50% margin account, you can buy $20,000 worth of shares, or 200 shares. You contribute $10,000, and the broker lends you $10,000. The stock price rises to $110 per share, a 10% increase. Without margin, your profit is $10 x 100 shares equals $1,000, a 10% return on your initial investment. With margin, your profit is $10 x 200 shares equals $2,000. After paying, say, $100 in margin interest, your net profit is $1,900, a 19% return on your initial investment. Example 2, the downside, margin call. You use the same scenario as above, but the stock price falls to $80 per share, a 20% decrease. Without margin, your loss is $20 x 100 shares equals $2,000, a 20% loss. With margin, your loss is $20 x 200 shares equals $4,000. Your total portfolio value is now $16,000, 200 shares x $80. Your equity is $16,000 to $10,000, loan, equals $6,000. Assuming a 25% maintenance margin, you need to maintain $4,000 in equity, 25% of $16,000. You have $6,000, so initially, you are okay. However, imagine the stock falls further to $70. Your total portfolio value is now $14,000, 200 shares x $70. Your equity is $14,000 to $10,000, loan, equals $4,000. You are still okay. Asterisk now, imagine the stock falls to $60. Your total portfolio value is now $12,000, 200 shares x $60. Your equity is $12,000 to $10,000, loan, equals $2,000. Asterisk your maintenance margin requirement is now $3,000, 25% of $12,000. Because you only have $2,000 equity, you receive a margin call for $1,000. Asterisk if you don't deposit $1,000, the broker will likely sell some or all of your shares to cover the shortfall. Code examples: simulating margin account dynamics, conceptual. It's important to understand that you can't directly execute trades or query real-time margin information within these code snippets. You would need to use a broker's API for that. These examples are purely for illustrating the calculations involved. Explanation of code snippets asterisk. Asterisk calculate underscore margin underscore call. This function takes the current stock price, number of shares, loan amount, and maintenance margin as input. It calculates the required equity and determines if a margin call is triggered. If it is, it returns the amount of the margin call. Asterisk calculate underscore leverage. This function calculates the leverage ratio, portfolio value / equity. Asterisk calculate underscore profit underscore loss underscore with underscore margin. This calculates profit, taking into consideration the interest payment on the borrowed funds. Connecting to broker APIs, brief overview. To trade with real money in a margin account, you'll need to use a broker's API, application programming interface. Most major brokers offer APIs in languages like Python, Java, and C++. Here's a general overview of the steps involved. 1. Open a brokerage account asterisk you'll need to open a margin account with a broker that offers an API. 2. Get API keys asterisk you'll need to obtain API keys, usually an API key and a secret key, from your broker. These keys are used to authenticate your trading application. 3. Install the broker's API library asterisk install the appropriate API library for your chosen language, example ABAPI for interactive brokers in Python. 4. Authentication asterisk use your API keys to authenticate with the broker's API. 5. Data retrieval asterisk use the API to retrieve market data, account information, and order book details. 6. Order placement asterisk use the API to place buy and sell orders. 7. Error handling asterisk implement robust error handling to catch exceptions and handle potential issues, example network problems, API errors. Example, conceptual, using ABAPI, requires interactive broker's account. Important considerations and risk management. Asterisk know your risk tolerance asterisk understand how much risk you're comfortable taking. Margin trading is not suitable for everyone. Asterisk start small asterisk begin with small positions and gradually increase your leverage as you gain experience. Asterisk use stop loss orders asterisk set stop loss orders to limit your potential losses. A stop loss order automatically sells your security if it reaches a specified price. Asterisk monitor your account regularly asterisk keep a close eye on your account balance, equity, and margin requirements. Don't rely solely on your broker to notify you of problems. Asterisk diversify your portfolio asterisk don't put all your eggs in one basket. Diversify your investments to reduce your overall risk. Asterisk understand margin requirements asterisk know your broker's initial and maintenance margin requirements for each security you trade. These requirements can vary. Asterisk be aware of interest rates asterisk factor in the cost of margin interest when evaluating potential trades. Interest rates can fluctuate. Asterisk read the fine print. Asterisk carefully review your margin agreement with your broker. Understand the terms and conditions, including the broker's rights and responsibilities. Asterisk have a plan. Asterisk develop a clear trading plan with specific entry and exit points, risk management rules, and profit targets. Asterisk don't chase losses. Asterisk if you're losing money, don't try to recover your losses by taking on even more risk. Asterisk avoid over leveraging. Asterisk just because you can borrow a certain amount doesn't mean you should. Ethical considerations. Brokers have a responsibility to educate clients about the risks of margin trading. They should not aggressively push margin accounts on clients who are not suitable for them or who do not understand the risks involved. Clients, in turn, have a responsibility to be informed and to make responsible trading decisions. In conclusion, asterisk margin accounts can be powerful tools, but they come with significant risks. Thorough understanding, careful planning, and disciplined risk management are essential for success. Always prioritize protecting your capital and avoiding excessive leverage. It's important to do research and only risk what you can afford to lose. Brokers profit from your trading activity and the interest you pay on borrowed money. They have a financial incentive to encourage margin use. As such, you should not rely solely on the advice of your broker and seek out other independent sources to make trading decisions.